Alright, so it's the 1st of May, the start of a new month, and time for monthly market analysis. But before that, a quick disclaimer. So let's start off with the S&P 500. It continues to be in this downtrend consolidation pattern. We had that break above the resistance in middle of March when it made that first low, and I thought, hey, okay, that's it, that's the low for the year, we're now going back up, and it did go back up, but then it hit resistance, couldn't break through, and came back down again. So we can't predict the market exactly, as you guys know. So we're down again, and now we have gone below that previous support, but still above that swing low in middle of March. So I won't be surprised that in the next few days, we will go lower and retest those lows and possibly exceed those lows. Usually a bottom forms when you've got a double bottom and the second bottom exceeds the low of the first bottom. So in other words, it goes below that low and then reverses back up. That could be a possibility. Another possibility could be it could test all the way down to 17%, which I did mention early this year, because I said that usually in US midterm election cycle, the market has been known to correct down to 17% on the S&P 500. So we'll see how that goes. But the S&P, well, technically it's not in a bear market yet, although it looks like almost every stock that we own is in a bear market. The Nasdaq's in a bear market, but the S&P is kind of like holding up pretty well because of energy and staples and utilities. So in a way, I agree with what some of you are saying, that this actually feels like a bear market. It's kind of like a stealth bear market where, again, a lot of the companies we own are down 20, 30, 40%, but the S&P doesn't show it's a bear market because it's being held up by certain parts of the market, like I said, the energy, the utilities, the consumer staples. But even though it's not a bear market, it might as well be a bear market because most of our stocks are down more than 20%, which I'll go into depth in the portfolio review. So year to date, the S&P is down 13%, all right? And the Nasdaq is in a bear market. So bear market means the market closes 20% below the high. And if you look at the Nasdaq, yep, we are down, back down below the March lows. So again, this could be a sign of a double bottom. You never know, right? It could double bottom. If it forms a strong bullish candle, we could reverse back up next week. We'll see how that goes. But bad news is that it's below the 20% peak, so Nasdaq's in a bear market. So Nasdaq's down 23%, S&P is down 13%. Now, my portfolio is down 27% year to date. This is a bigger drawdown than what I had in March 2020 during the COVID crash. During that crash, my portfolio was down 26%. Now it's down 27%. This is huge. Now, a lot of investors would feel upset or feel scared. Oh my God, what's happening? My portfolio's down like 27%. By the way, in terms of dollars, I'm down like 1.3 million from the top, okay? Now, I'm not upset. I'm not worried. I'm not fearful. In fact, I'm still pretty optimistic, pretty excited. It's not because I'm crazy. It's because I've been in the markets for 30 years. I've gone through so many bear markets. I've been through so many corrections. I went through 2000, 2008. I went through 2018. I went through the March 2020 crash. And after every bear market, after every crash, I always got richer eventually. Every time my portfolio dropped by 20%, you'll go up 50% or 100%. In fact, in March 2020, where my portfolio dropped 26% during the March 2020, it ended the year up kind of like about 48%. And then the following year, 2021, my portfolio was up another 46%. And then, so overall, after dropping 27%, my portfolio went up 100%, right? So this will be no different. Yeah, my portfolio may be down 27% right now, but by the end of this year, or maybe next year, or the year after that, it's going to be up like 50, 100%. I know that for certain because I'm invested in great companies that are undervalued and they will always go up. They always go up eventually. Maybe not now, maybe not next week, maybe not next month, but they will go up eventually. So my confidence comes in understanding the businesses that I own. Now, as usual, I'll go through all my stocks in detail in the portfolio review videos. Now, some critics would say, but Adam, if you're so smart, why are you down? If you're so smart, you could have seen the crash coming, you should have sold everything at the top and shorted the market at the top and bought commodities, and now you would not be down at all. You'll be like up every year, every day, every month. Well, it's because I don't have a crystal ball, dumbass, and no one has a crystal ball. So the reason why a lot of people fail in the markets is because they come in with unrealistic expectations, thinking that as a great investor, you can see the future. You know exactly where's the top, exactly where's the bottom. And that's why most people fail, because they come in with these naive expectations. Hey, even the greatest investor in the world, Warren Buffett, who's been investing for the last 80 years, his portfolio doesn't go up in a straight line. It goes down as well. In fact, he has seen his portfolio drop like up to 50% more than 4 to 5 times in his career. And there's only one guy on Wall Street whose investment portfolio never goes down. It goes up like every single year without fail, has never dropped at all. And his name is Bernie Madoff, who was found to be the greatest scammer and fraud on Wall Street because all his investments were all fake. It was a huge Ponzi scheme, and he was sent to jail for 100 years and he died in jail, right? So the point is this. The point is, if anyone tells you that they can see the future, they can sell at the top, they can buy at the bottom, it always goes up, it's a freaking fraud, okay? It just doesn't exist. So if you think that way, grow up. Okay, don't be so naive, all right? So like I said, I'm not fearful. I'm excited because I know that it's part of the journey. And it's kind of like marriage, right? You can't have a great marriage without arguing once in a while. And after every argument, that should strengthen your marriage. It's unrealistic to think that, I'm going to have a marriage for like 50 years, never argue, happy every single day. Yeah, try. Try that. Go ahead. Best of luck. It's the same thing with a business. In business, you can't always have sales. You gotta have sales and cost of goods sold, and that gives you profit. So I look at my portfolio the same way. My portfolio goes up, it's like sales, but I can't have sales all the time. I gotta have some cost once in a while before the next sale. And remember that the market is kind of like a breathing pattern, right? Breathe out, breathe in, breathe out, breathe in. No matter how strong you are, you can't breathe out forever. It's impossible. You can't, right? You gotta breathe in once in a while before you can breathe out even further. So the market is designed in a way that you have to take one step back to take 3 steps forward. And sometimes you take 3 steps back like now, or 4 steps back to take 8 steps forward. So once you understand that that's how the market works, you don't get upset, you don't get concerned during these drawdowns. You expect it, you anticipate it, and you go with the process, you enjoy the process. And why not? I always say enjoy the journey. It's not just the destination, it is the journey. And I tell people that if you buy a portfolio of great companies, underlying good businesses, and you buy them at reasonably good prices, you don't have to buy at the bottom. As long as you buy them when they're undervalued, collectively, it is impossible to lose money. It is impossible to lose money because eventually they will go up again to new all-time highs, right? The only way you can lose money is if you sell halfway at bottom prices because of fear, because you panic halfway, and as long as you invest with money you don't need urgently, you don't invest with borrowed money, there's no one forcing you to sell. You just hold it through those ups and downs. So as I always like to say, the stock market is like a roller coaster. And the only people who get hurt on the roller coaster are those that jump off the ride halfway. If you stay in the ride and enjoy the roller coaster, you will reach the destination eventually. So let's take a closer look at what is under the hood of the S&P 500. Again, the index is down 13%. Not that much, but my portfolio is down 27%. And I would guess that for many of you, a lot of the companies that you hold are down more than 20%. So you may say, why? Why am I underperforming the market? Now, the reason I am underperforming the market so far this year, I've mentioned before, is because my portfolio is concentrated into technology companies, consumer discretionary, communications company, which so happens that now these are the ones that are down the most. These are the sectors that are down the most. If you take a look at year to date, you can see, communication services like Facebook, for example. Disney is down 24%. Right? Technology, like your Microsofts and your Viva and your Salesforce is down 23%. And consumer cyclical, which are consumer discretionary stocks like Nike and so on and so forth that I own, is down 22%. So my portfolio is concentrated in the three sectors that are getting bashed the most so far this year. And of course, I've got a bit of healthcare, I've got a bit of real estate, and a bit of industrials, which are also down 11%. So in my portfolio, I don't have any exposure to energy. I don't have any basic materials. Consumer defensive, I have a few, and I've got no utilities. So notice that these are the ones that are propping up the market, and that's why I'm underperforming, because I don't have these sectors. And I mentioned why I don't have these sectors is because in the long run, technology, communication services, and consumer cyclical, and healthcare and financials, in the long run, these sectors outperform the market, because these are the sectors with the highest growth, with the highest profit margins, and with companies with the strongest economic moats. But in the short term, they're not doing well because the market sentiment is kind of like, going away from growth, away from innovation, and towards all these safe kind of sectors, right? So should I sell my stocks and buy these ones that are going up? That's what some people are doing, right? They sell the out of favor and buy the ones in favor, and like they want to catch that trend. So I don't want to do that, because right now these sectors are pulling up the market, but they are overpriced, and in the long run, they don't perform. So I'm going to stick with the sectors I have and use this opportunity of a big drawdown to slowly keep buying shares into the company. Because I always say that this is a crisis, and never let a crisis go to waste. Use it as an opportunity so that when it turns around and markets normalize, you would really outperform the market again and make a lot of money. So I've got no doubt of that. And I'm sticking to the investment plan. That's the key. Always stick to your investment plan and don't change it halfway and go chase what looks nice and abandon what you have, right? There's a very old saying in hockey, ice hockey, by Wayne Gretzky, this hockey great. He said, don't skate to where the puck is right now. You know those puck which they hit with that stick, right? Don't skate to where the puck is right now. Skate to where you think the puck will go to in the next couple of seconds, right? So that's what we do in investing. Now, if you take a look at the S&P 500, look at the component companies, you can see that again, the majority of the great companies, the one with growth, the one with strong economics, they're the ones that are getting hit the hardest in this very strange market, right? So Amazon's down 25%, right? That's a big position I have. I've got Google, big position, down 20%. I've got Facebook down 50%. I've got Microsoft down 17%. But the other ones that are green, holding up the market, are the energy stocks, right? These are all green. These are all going up, but I don't own any of them because in the long run, energy companies have low profit margins, are unpredictable, and they underperform in the long run, right? So I don't touch any of those. And again, no regrets not going in a short term because I'm sticking to my plan, right? Healthcare, I've got a bit of healthcare. Should have bought more, but I've got a bit of it. So that's kind of like holding my portfolio up. But that is what's doing well so far this year. And I've got some of these financials as well. And of course, basic materials, commodities also pulling the market up. So if you're like me, and again, your portfolio is underperforming the market and you're wondering why am I down 20-30% when the market's only down 13%, you're not alone. All right, a lot of us are going through that, including me. But don't worry, when things turn around, it would flip the opposite and you will way outperform the market. Okay,